Good morning, good afternoon. Not sure where we find you today, but thanks for joining us on our quarterly market update call on this fine Thursday, April 18th. Again, quick update with respect to the team. Madeline will be back next week, so we're excited to have her, helping out run the show for the planning side. She and Tom are not on speaking terms, unfortunately, they. Or fortunately, depending on how you look at it, from Maddie's perspective, the University of Denver beat Tom's BC Eagles in the Frozen Four finals this past week in a big upset. So I hope those two will make amends here next week when Maddie gets back. But thanks for all the well wishes and the reaching out. We'll be excited to have her leading the seminar on or the webinar on the market update for Q2 in July. With the recent market volatility, we have a number of folks attending today, more than usual. We're happy to have a big crowd. We've got folks in 4 countries, 30 states, give or take, and again, really just happy for you to share some time with us today. Let me just take you through the agenda here. The idea is we'll try to keep this to something resembling a reasonable timeline, probably close to about 45 minutes of our chatting, and leave it open for Q&A. Quick update on the firm. Again, we coming up on our 2-year anniversary. We're ecstatic, relative to the business results, and frankly, just grateful for the partnerships for those of you who are clients, and for those of you attending who are not yet clients. We'd love to have a chance to tell you a little bit more about what we do and how we do it for you. So bear with me for just a second here. I want to make sure the presentation is looking correct here. It's getting a little bit of a clunky. Well, let me come back to that in a second. So just to cite our various sources, we're grateful to have really wonderful resources from Charles Schwab, who we use as a custodian, as well as JP Morgan, who puts out a wonderful guide to the markets, probably one of the best pieces of content that's out there. The other data we've captured come from a variety of sources. Most of this stuff is publicly available. There are some instances where we have information that, frankly, is for subscription basis, stuff that we ultimately have to pay for. If it's information or content that you want more information on, we're happy to see if we can provide it. The idea here is give you a bit of a look as to what took place here most recently relative to the first quarter. I know for some folks, here we are the 3rd week of April, that becomes or seems a bit stale. But for what it's worth, some of those themes or trends are important as we think about where we are right now. Again, beginning the year, right, it was all about rate cuts, or at least that really kind of started last October, corresponding with the rally that we saw in all things, mainly in the equity markets, were up about 30% from Halloween. But we did see some strength in the bond market as well. And, that last 2 months of 2023 bled into the first quarter, and we saw, the best start to a year going back to 2019. If you recall, 2019 was, kind of after the market had a chance to digest the impact of the Tax Cuts and Jobs Act, right? And so we had a marvelous year in 2019. Hopefully, we'd be so fortunate to repeat that. It's only the 11th time going back to 1950, so in 70 plus years, where the market had registered a double-digit return for the first 3 months. And while the rate story is definitely part of it, we'll talk about that quite a bit throughout the discussion today. It's really been about an improving picture on the part of businesses, both profitability, margins, labor markets. So just really encouraging. And so I think that some of the rally was most warranted. Some perhaps a little bit caught up in some of the moment euphoria. And what we witness here, which is a little bit of a rare occurrence, is that you've got a phenomenon where the market, which generally progresses through something resembling a early, mid, late, and recessionary timeline, has kind of gone from late cycle to mid cycle. And again, that's encouraging, because that just means the cycle will potentially be elongated. If we go back to the post GFC expansion, we had a couple instances where we saw kind of late cycle signaling only to find ourselves back in mid-cycle. So if we could again see an expansion that was nearly a decade in length, that would be great. I'm not sure that's in the cards, but again, just a positive development. Um, we'll spend again time on wage growth and the like, but the for the first time in a while, wage growth is actually ahead of inflation. And so on one hand, that's good, right? People have more real wages, but higher real wages actually generally tend to be a bit inflationary in and of themselves, right? If you have a little more disposable income, you may end up spending that money. We'll obviously want to address the humanitarian issues that are present in Ukraine and obviously the Middle East, and there's the ongoing concerns about what's going on in the Far East in Taiwan. Here we are now, roughly about 7 months out, less than that from the election. So even just in the last couple of days, we've started to hear some policy agenda items for both President Trump and President Biden, and so we expect that just to dial up here over the course of the next few months, I should say, excuse me. And then lastly, Bitcoin, which I'm not a huge fan of, as you know, if you've tuned into these sessions over the last couple of years, but it clearly has got people's attention again, rocketing back to at one point about $75,000 before now settling back in the mid 60s. So again, we'll dive in. I'm going to turn over to Tom. Tom will take us through a bit of a kind of macro update, and then we'll kind of bounce back and forth throughout the discussion today.
Thank you, Jeff. Appreciate it. I am struggling a little bit with a cold right now, so I'll apologize in advance. I have a deeper voice than usual. Maybe that sounds good. Maybe it doesn't. I don't know. But if I have to drink or cough during the presentation, I apologize in advance. But as Jeff mentioned, just going to start off with a little bit of a macro update. Initially looking backwards, this slide shows Q3 for GDP. Positive 4.9%, Q4 positive 3.4%. And if you look at the orange bars there on the right, that's really been above trend recently. And as you see in bold there, increased productivity is allowing the market to grow above trend, which in so many ways and for so many reasons, as Jeff mentioned, it's kind of taking us from late cycle and kind of almost sucking us back into mid cycle as far as the business cycle goes. Which is a good thing in so many reasons. But as you look at interest rates and the impact, which we'll cover as Jeff mentioned in detail, there's a kind of a push and a pull with that, a bit of a tug of war. So we will talk through that. Jeff, if you don't mind, jump to that next slide.
Sure.
So as you look at Sorry, go ahead.
Folks, sorry for the technical difficulties with respect to some of the banner. I apologize. That's me, fooling around a bit. But again, the content's there. Tom, please, right back to you.
Sure. Yeah, absolutely. So stock rally continued in Q1. So good for stocks, but the rising yields weighed on bonds a little bit. Obviously, we've seen a bit of a change going into Q2 and April. But, as we look at Q1, U.S. growth 11.2% for the quarter, which is fantastic. Large cap stocks were at 10.6, value 8.6, even gold, which is interesting. A lot of times you don't see the stock market and gold going up at the exact same time, but gold was up 8.1. And if you look at the 1-year performances of even just those top four, 38%, 29.9, 20.2, 13.2. And then you have some international right down there under gold at 5.8 for the quarter, 15.3 for the year. So really strong first quarter, and interesting kind of table setter for the rest of the year as far as where we end up going, what kind of growth do we see, and we're keeping an eye on all these different sectors or pieces of the market just to watch, definitely both on the equity side but also the bond side. If you think of the interest rate changes that have gone on and the Fed increasing rates over time, it does insulate the bonds to some degree, as far as just not having hopefully a really dramatic down year. Usually bonds, again, are a component of your portfolio to or keep you wealthy versus make you wealthy. But if you look over on the right side of things where you kind of that top section, but down at the bottom where it says, U.S. corporate bonds down 0.4%, investment grade down 0.8, long-term credit, government and credit bonds down 2.4%. So as I mentioned, the stocks looking really strong in the first quarter. Bond yields, were impacted for sure, and total return there. Jeff, if you don't mind, flip to that next slide. Onto unemployment and wages. This is something that we've covered, and I think in multiple quarterly market updates, and it's interesting to watch the trend lines of wage growth, where we saw coming out of COVID, wages went up pretty dramatically. You had so many people who were not quitting their jobs, but not necessarily working maybe as hard as some of their companies wanted them to. Some people really did go out and make career changes, quitting their jobs, making changes and pushing the wage growth higher as they were seeking new opportunities, and companies were desperate to add people to staff. They were finding themselves in competitive situations. Wages were being pushed higher, which is inflationary. You look at March 2022 on the blue line there was at 7%. Now it's down to 3.9. Or excuse me, sorry, that's the wage growth. The 50-year average is about 3.9. We're above that, but down below certainly the March 2022 highs. And then the unemployment rate, 50-year average at 6.2%. We're still right down below 4, which is fantastic to have so little unemployed people versus that long-term 50-year average. Next slide, please, Jeff. Thank you. So U.S. unemployment rate, as I said, it's 3.9%. It's very low. On the right-hand side of this chart, as you see the chart to the right, total not in labor force population, 5.1 million workers, have left the labor force since January 2020. So people who have just basically stopped looking for jobs, which could be people retiring. It could be younger workers who are just not looking for full-time work. So it could be people going back to school. It could be a whole host of different reasons, but 5.1 million workers have left the labor force. Often that would be inflationary, so less people for the same number of jobs. Employers have to then raise wages essentially for people to compete for those jobs. But as we saw in the last slide, that's actually come down, which is a good thing from just an inflation perspective, right? So interest rates playing into where inflation is, and as I said, a bit of a push and pull on that topic. On the next slide, labor demand being robust, right? So reducing the gap between job openings and unemployment. That is one of the major things that the Fed is focused on. Fewer people are right now quitting. I think we kind of absorbed that into the system over the course of time. And we're in a better position now where less people are, I think, kind of fed up with either how their company handled COVID, or they were just, stressed out, burnt out, whatever it is, with their jobs. And so that has actually improved. That's been a very good thing, and it's definitely helped alleviate some of that the supply side. And again, it's kind of helping put downward pressure on the wage inflation. So that is a good thing overall as it relates to inflation. On the next slide, business and consumer confidence. So we haven't yet seen small businesses really start to spend as far as what their plans are. So that is something that we're paying attention to. I think it's going to weigh on what happens with the economy, and is there more softness. There's also softness on the service sector side of things. So as you look at the title there, restaurant and bar sales are a good indicator where there is some softness there. It's more been softness on the good side of things. The service side of things has actually been more on the inflationary side, which I think we can actually see on the next slide. So on that right-hand side, we'll jump to that first. The services. Sorry.
Sorry, yeah, we hop ahead. My apologies.
Just on slide 12. Yeah, perfect. So if you look on the right-hand side of that, the lighter blue line, um, services, again, on the uptrend as far as money spent, it's on the more inflationary side. There's been more softness on the service side of, or sorry, on the good side of things, which is interesting. But again, like the bar and the restaurant, as I said, there's some softness there. Things do look to be improving on the good side as well. So, the trend is still up and to the right, and I think it will continue to increase. On the left-hand side of this slide, as it looks to that the yellow line, personal savings rate. So on the left side of it, you can see there was that big spike in 2020. Nobody was leaving their house. Everybody was saving a bunch of money. They had already probably paid for their Netflix subscription and, or watching Tiger King or whatever it was. It was the show du jour back in 2020. As things started to open back up, people were saving much less. So just as far as percentage of their income, and it actually did go negative, kind of end of 2021, beginning of 2022. And the blue lines are really credit cards, or other types of credit. And you can see, that's definitely spiked up since COVID, where it was negative, on the left-hand side of the chart. It spiked up quite a bit, and it's been kind of up and down, month over month for the past few years now. And the savings rate, as I said, has gone negative kind of across the country. So next slide, please. And I like this view of the personal savings rate, because you can see the average is the blue line that kind of goes across the middle there, where it says 8.5% of personal income is the average savings rate. You look at it, and it's interesting because even if you go back to, say it's 1993-ish, right, was the last time we were above it, we went very negative, and then again, you get into COVID and it spiked very high. Whereas in 2024 year to date, we're only at 3.8% compared to that average of 8.5. And if you look in the chart in the upper right-hand side, the household excess savings. So you look at the kind of blue cloud there, it is going down, going from 2020, built up quite nicely into 21, 22, and then you see it kind of sloping downward in 2023 and 2024. So, where some people are actually, they're saving less, they're actually spending a lot of the savings as well. And as we saw on the last slide, some people are really actually getting into some credit card debt to go along with it. So interesting to watch, interesting to see how that's going to impact the economy. Eventually people will, if we continue on this trend, they run out of savings, it'll be more into credit cards potentially, or, something happens, we may see savings rates tick back up. If we could jump to the next slide. Thank you, Jeff. And this is just a housing update, which I feel like has been front and center for so many people trying to either buy a home, or if you're selling a home, just where interest rates are, where home prices are. If you look, just the sales have been down. So the upper left chart there, sales have been extremely low, just as far as the number of units being sold. If you look to the right of that, just where rates are, right, it makes sense. Home prices have gone up. Rates have gone up very significantly. They're as high as they've been in the last 20 years or so. We went through a period of time where interest rates were down in the high 2s or low 3s. And you have so many people who are not even willing to sell their home because they look at it now as such an asset where, a money market can get you in and around 5%, and your mortgage rate, could be down at 2.75, 3.25, somewhere in that range. It is a significant asset for people, and you see less people paying off their mortgages early because they realize that. Down in the lower left, you see just the affordability index, and we are at such a low point because, again, home prices have gone up. You have mortgage rates go up, and just the amount that you have to pay. I don't know if anybody's actually gone through that exercise themselves. I've done it where if I were to go and try and buy my house today versus when I bought it in 2015, what would I actually have to pay for it today, just from a price perspective? And again, think of the impact on your regular mortgage payment with the rate and the mortgage that you would have to take to buy your home. While you're in there, if you're looking to feel better, you just look at your estimate. If you're a homeowner, you can look at your estimate. It's probably gone up pretty dramatically in the last 8 or 9 years, and you can look at it and say, hey, if I ever were to sell it, there's a pretty good chance you're gonna walk away with a profit. Just the last chart quickly before I turn things over to Jeff. Just mortgage applications down significantly based on all of those factors. So you can see it spike up in 2020, where people were buying COVID homes, second homes on a lake or in the mountains or by the ocean or whatever it might be, whatever recreational activity appeals to you most. And but you look at it, really kind of significantly gone down since then. 22, 20, 23, and certainly 24, mortgage applications down significantly. So with that, I will turn it back over to Jeff.
Okay, so looking at the housing update, I just want to call attention to on the lower left quadrant, right? Like the idea that home affordability today is actually lower than it was in the midst of the craziness that took place during the housing bubble. And so there are all the stories about people owning six or seven homes, and clearly fed a significant amount of fervor and higher prices. Some of that was rate driven, but it's just interesting to see today that affordability is at historically low levels, and it does make the case for renting for a lot of younger people and even older folks. We've seen some clients who've decided, hey, I don't necessarily want to deal with the maintenance and the taxes and stuff that goes along with owning my property, and so renting is becoming a little bit more of an easy decision these days given affordability. Let's come back to the inflation piece Tom had alluded to a little before, right? So for a quick history lesson, inflation peaked in June of 2022 around 9%, and you had a kind of a combination of two things then. So you had the back end of goods inflation, because if you're staying at home, you're buying furniture and computers and all this stuff, and frankly, you moved from Manhattan to Westchester or further out, you needed a car, and so you saw a lot of good spending. And a lot of that stuff tends to be non-recurring or irregular, right? Those are durable. That's kind of the name of or that's often what we call durable or goods, right? And so it makes sense that you can see kind of more cyclical patterns within the goods consumption. And then services, the start of revenge spending occurred in the summer of 2022. Although I'll tell you this, people were still wearing masks then. And so 2023 is really probably saw the peak of the revenge spending that is on the services side, right? So as we look at the elevated inflation rate, a lot of it has been, driven by services, right? And just this, year, we're talking about 3 CPI prints, all kind of hotter than expected. Some of that is again, very much on the basis of continually high service expenditures, excuse me, but goods have actually started to pick up a little bit, and so we're seeing that a little bit in some of the data. We're also seeing it in manufacturing, for the first time in a few months, in 18 months. You go back to like the fall of 2021, or almost 2 years, I should say. Manufacturing started to expand again, and manufacturing is only going to expand if we start to see some demand there, right? So we're watching this situation closely. We'll spend a little bit more time on service inflation and what's referred to as like core inflation, core services. And that oftentimes is seasonally affected, in the first quarter. But again, let me save that for a little bit later. Money supply has contracted significantly, right? Well, that's an interesting thing, because historically, money supply is in all things inflationary, right? That's a famous Milton Friedman paraphrase. And so we saw a massive spike in M2 money supply back in 2020, 2021, 2022. Since then, money supply has shrunk, but it's crept up a little bit here of late. Again, perhaps that's somewhat of a source of this inflationary bounce. Again, I'm not convinced that we're not still in some sort of transitory inflationary environment, but it's definitely become harder to get to the last mile. Here's the kind of breakdown of what you see with the inflation constituents, right? And so we all know headline inflation when we see gas prices, which have been on a kind of an upward move here for the better part of 2 months. Some of that's driven by shutting down refiners in the U.S. So it's obviously the concerns about Middle East oil supply. But we also see things like medical services, right? It's a big jump. Insurance is another one. Automobile insurance, a lot of insurance pricing and homeowners insurance has obviously been a big topic. Happen typically around a calendar quarter, and so some of these things generally tend to be less front of mind, right? When you think about inflation, but they're big drivers of CPI. The Fed's preferred inflation measure, PCE, which we'll hear next week, likely will continue to stay in that sub 3% territory. But again, instead of going from 2.8 where it stands today down to 2.1 or 2.2, where they could probably resume their victory lap, inflation's been somewhat stubborn here. The good news is inflation necessarily isn't the same problem overseas, right? Again, Russia, we don't spend a ton of time thinking about because it's really uninvestable, both literally and figuratively. But India, 5.1% inflation rate sounds like horrifying to us. That's really a pretty welcome number. And India's been growing at a rapid pace. Tom will provide some color there when we talk about global markets. But if you look outside the U.S., in a lot of the developed world, they're at 3 or under. Even China is essentially kind of flat, right? And so the second largest economy, somewhere between deflation, disinflation, or inflation, that's kind of kept a lid on inflation. So what also means there's a possibility for rate cuts a little bit sooner. We've heard that from the UK. Christine Lagarde, from the ECB, had kind of intimated that June's on the table. And so again, if inflation does continue to dissipate abroad, that does give monetary policy some runway, and perhaps means that disinflation might be exported into the U.S. Could be a positive. Again, just sticking on the theme of inflation and long run, right? So here we are. 50-year average headline CPI is 3.8, right? We're at 3.2, right? So I know people are like running around with their hair on fire, but we're actually below what the long run average is. Core CPI is kind of right in line with the long run average. Food is actually, and energy both have been kind of trending down. Energy will start to trend back up over the next few months, whereas food likely actually is going to continue to trend down. There's actually some positive signs, hopefully, for weather patterns that this year will be better for supply when we think about crops, because last year was pretty miserable with an El Nino. A lot of moisture and yields for crops were on the lower side. I was talking about before with the Fed and their preferred inflation measure. You can see PCE at 2.8. Again, that they'd love to see that number back around 2, and that's really not going to be where they'll start to cut rates. They'll do it before then, but it's got to continue on its downward trajectory like we start or much through 2023. I want to go ahead and just hit on inflation one more time, right? Because it's everyone's talking about today. If you look at inflation in the context of CPI, right? Shelter is a huge component of that. The PCE underweights the shelter impact, and you can see here, this is the sticky price inflation, which the Atlanta Fed looks at. So sticky price inflation are things that, generally speaking, don't move around month to month. They tend to move from year to year. So it might be tuition. It could be, again, back to insurance. And so it's kind of stalled a little bit, right? We saw a nice downturn, right? Parabola, it started in 2021, 2022, and really the curve bent down. But you start to see that creep up a little bit. And even if it doesn't creep up, it kind of stays there. That's what has the Fed a little bit concerned. I wouldn't say nervous, but just cautionary. Again, probably enough for us on the basis of inflation today. We'll talk about that as it relates to equities and interest rates in a minute. But let me switch gears here and transition to a conversation about a big driver of inflation, which is oil prices, right? So I'm sorry, let me come back to that. That's in the commodity section. This is dollar dynamics, right? So in a couple instances over the last 2-3 years, we've seen the direction of the dollar have a lot of impact on what happens with asset prices, right? So the combination of a growing economy and a less dovish central bank generally portends a stronger dollar. And the stronger dollar does help us if we're traveling to Europe or we're going, other places where, translating dollars to the local currency is to our advantage. But it does have some impact on trade, right? Our manufacturing becomes less competitive. It frankly can impact, foreign borrowers in the marketplace because the cost of capital essentially has risen if they denominate their debt in dollars, which is often the case. And there's also a very important issue that the Fed wrestles with as well, as if they're loath to cut rates, but other countries start cutting rates, and that bleeds into longer term debt. The yield differential will be another reason why assets will want to make its way to the U.S. in safe haven assets, so dollar themselves or treasuries. So we don't want the dollar to be too strong. I know that's kind of a crazy thing to say, but a strong dollar can have some adverse effects on the global economy. So let's switch gears, talk a little about stocks, right? Again, a lot of people are wondering here. Now we're in the midst of something that resembles a correction, right? Small cap stocks are probably close to that at present. Large companies have held up a little better, but as we're on a one-way train for 5 months, sometimes it feels a little bit uncomfortable. When we've given back some of the gains here in 2024. This is the S&P, and you look back really over the last 30 years, right? So it's been a nice looking line, a couple of pretty interesting air pockets along the way. And today we look at the index around 5,100, so down a little bit from that all-time high there. But the multiple is around 20 times, still historically on the higher side. If you look at long-term averages, 30-year back, it's 18. So you'd say the market's probably about 10% above its 30-year average. And the long-term average is long-term being last 100 years about 16 times. So at 20 times, the market's about 30% above its long-term run. That doesn't mean the market's ripe for a 30% correction, measures imagination. It's not uncommon coming out of a recession or something resembling an earnings recession for that matter, that multiples can be a little bit high, but it just does speak to the fact that you don't have a cheap market out there with a lot of springboard effect for price. Dividend yield on stocks historically remains quite low. Part of that's, when you look at the S&P, so many of the big companies that make up the index are technology companies. Meta Platforms, formerly Facebook, introduced a dividend in their January earnings call. We might see that from the likes of Alphabet and Amazon at some point, but again, the S&P yields a little less than 1.5%. And the 10-year all the way up to 4.2. At the end of March. Now we're actually at 4.6 as we speak to you today. So again, the market tends to ignore rates in the long run, but in the short run, it does have some impact, no doubt. Let's dive into a little bit more depth on the market. And when you think about the U.S. or kind of leadership of American exceptionalism or elitism, we had a strong quarter, no doubt. You look at the S&P up 10.6%, but if you dive into Europe, Germany, Spain, Italy, all kind of aligned, or if not ahead of Japan, 2x, right? So good quarter for the U.S., no doubt, but an even better for a lot of the Western world, where the market again didn't do as well as I think about overseas is emerging markets, and that comes back to a little bit of the concern about stronger dollar and perhaps a little bit more headline inflation, specifically on energy prices, where they, in most countries or many countries, end up importing a lot of energy. Drilling down deeper a little in the U.S., here's the sector makeup, right? Like tech leading the pack, nothing new there. But if you get down, financials, healthcare, two of the kind of laggards in 2023. In the early part of the year, they actually finished strong. But by and large, welcome to see financials up 12.4%, which would have put them just a little bit behind consumer communication services, energy, and technology. And then what didn't perform, right? If we want to look at it from the standpoint of first quarter, real estate again makes sense, right? There's still this ongoing worry about commercial real estate and people working from home, but also a lot more interest rate sensitivity. Utilities, which are now actually probably trading slightly down on the year, also kind of lagged. On a 1 year basis, it looks pretty darn good, right? S&P's up 30%. a lot of, again, driven by tech, but even, the worst performing sector, utilities, was flat over that 12 month span of time. So good to see. If you jump over to the right there, third column from the right itself, you can see median PE. I was talking about 16, 17 times going back to 1990. There are a handful of sectors that trade below their longer average, and there are a handful of sectors that trade above their long-term average. Sometimes that's warranted, sometimes less or so. And so, that's something we'll look at, to identify opportunities where we might be interested in perhaps nibbling a little bit. Um, the way of thinking about the market today, and we've alluded to this probably in 3 or 4 consecutive meetings, is we still have a tremendous amount of concentration, right? The Magnificent Seven, and for those of you who are music buff or movie buffs, that was the theme song I was playing at the beginning as we kicked off the meeting. Some also may know that as the Marlboro theme song, which is not what we're trying to convey. But the Magnificent Seven, or Magnificent Six now it's become, or even Magnificent Five. Tesla's been kind of cast aside, and even Apple's had its struggles here early in 2024. Still represent something close to about 35% of the market in terms of just capitalization, and you can see they've been big drivers of performance. But as you look at the kind of lower right hand side, the light blue and darker blue, not navy blue, but it has been a story where the S&P, aside from the Magnificent Five stocks, or the kind of mega caps, has actually done well, right? We've seen some kind of broader participation in it started in the fall last year, and that's healthy, right? Breadth expanding is a good thing, right? Let's look at the market at a heat map level, right? This is, to me, kind of one of the cooler slides, and you can see this is year to date. So this is updated through, I believe, close of business on Wednesday or Tuesday. So this is a little bit more timely than what you saw with the previous slide. But again, big red numbers, right? Intel, Adobe, and Tesla, those kind of stand out. But Apple, which is a big stake, down almost 13% of the year. Nvidia, just kind of mind-boggling, right? Just to speak to that. At one point, it was up 80% of the year, which was basically with an $800 billion of market cap, right? So, you can see that if you grab the 10 or 15 big squares or rectangles, there's still a lot of concentration in the marketplace, right? But more green here than we've seen in other slides, right? More companies participating. As I go a little bit further into the market and thinking it from a valuation perspective, if you look at the S&P at a forward multiple of 20 times, again, that's historically on the higher side, and this slide is 21, but I'm adjusting for the recent pullback. You can see forward returns on a 1-year basis tend to be less stellar, right? Should be logical, right? If you have a high multiple, it probably means that price has already done quite well, and it doesn't mean that you're destined for a disappointment, right? There are plenty of instances where forward returns were quite solid, but the dispersion is pretty even, right? Below the line, above the line. And so again, short-term expectations are such that it would be reasonable to think that perhaps equity returns, if you're looking at the market cap level, might be a little bit more pedestrian. Same thing to the right. Again, this is kind of just taking out an investment time frame over a longer period of time, right? 5-year annualized return, right? Again, the good news is there's not a lot of deeply red, deeply negative, but again, returns are probably more likely to be consistently in the single digits versus the high double digits. So this isn't to be Debbie Downer. It's more to say, hey, if you keep trafficking in the same expensive stocks, you might find yourself, looking at less stellar results in the near term. And so again, that next slide will do a good job of kind of getting in a little more depth on that. So again, the market cap weighted S&P across pretty much every single metric here is probably expensive, right? And if you look at the equal weight index, right, so same companies just dispersed amongst all 500 constituents at a same ratio of 0.2%, it's far less demanding, right? The market multiple trades around 16, 17 times. So we've emphasized to clients, hey, it doesn't mean own all value and all small cap. It does mean that perhaps a little bit more value, or perhaps a little bit more mid and small cap does make some sense for us, right? Again, happy to take you through any of these fun ones like the Rule of 20 or Schiller's Cape, but you can just see the summary is such that wouldn't describe the market cheap by any standards today. That's the S&P, right? So again, to be very clear, we're not necessarily, oops, bear with me for a second, always looking at things from the standpoint of the S&P. Let me just get to the next slide. So here's the valuation, kind of gap between growth and value, right? So on a forward basis, the S&P at 21 times is really comprised of two cohorts, right? There's the value side, which trades around 16 times forward, and growth, which trades around 27 times. Both are above their long run averages, right? The value side is around 14, growth, current at 16 means you're paying a little bit more, but I think that can be okay in the midst of a cyclical recovery. Growth, really trading at 30% of its long-term average suggests that you really have things priced for perfection. So again, if we're looking at deploying a new dollar today, maybe instead of an even split between growth and value, it might be more 3/4 to value and 1/4 to growth. The long run averages, for growth versus value really tend to come in, right? If you look at, going back 100 years. But what's interesting, if you look at how growth and value tend to perform in the context of the higher interest rates, growth actually tends to lag. If you look at when rates are 4% or more, the green bar on the right is below the darker gray/black bar, and some of that's just because of growth stocks tend to be long duration, right? The perception is earnings are off into the future. You pay that multiple for that future earnings growth, but should you pay as much for it when you can get kind of a risk-free rate that's higher today? Whereas more value stocks tend to be shorter duration, or cash flow, or more free cash flow positive, or have a higher cash flow yield, and tend to oftentimes be a little bit more cyclical. And so again, just a recurring theme for us, Pounding Table, we do like value quite a bit. This is interesting too, right? So this next slide we pulled from AllianceBernstein. It's a look at estimates for 2024 growth and 2025 growth, right? So if you can see, the S&P growth is supposed to be up year on year, but on the Mag 7, right, growth is actually likely to decline. Part of that's a byproduct of the fact that they've been victims of their own success. And while the market has rallied, the market tends to be more forward-looking, and so I think some of that euphoria in Q4 and early Q1 was knowing that earnings in 2024 should be good for the Mag 7. But remember, markets forecasting, and if they expect earnings growth to slow, and that's the key here. This isn't to say that earnings are going to shrink; they're just going to grow more slowly. You could make the case that perhaps both domestically, but most clearly abroad, as earnings are likely to grow more rapidly in the developed world and the emerging markets, it's a case to be a little more constructive on some of those other areas. So again, hopefully that slide makes some sense. This is an important piece that talks about like how and why we may have hit a trough earnings in Q3 of 2023. We saw a fair amount of margin pressure by way of higher labor costs, higher commodity costs, and so margins last year really came in quite a bit. And so the reason why we saw any earnings growth, which is really in the fourth quarter, was a byproduct of a improved top line, right? And so there's been this talk about like, and it's come from President Biden about like greedflation and companies, increasing price of goods, and so that's true, right? We've seen companies, especially in the consumer staples business, take price, right? Like we'll push prices as high as consumers will go before they start to either reduce their consumption or frankly shift across brands. And Costco is kind of a case in point. So consumers are doing that. But as we think about into 2024, we should actually see some margin improvement, right? Long-term earnings growth is generally around 7.5–8%, right? Typically some of that's margin, right? Companies continue to be profitable and productive. We've seen for the last 30 years a lot of it's just been technology. AI is perhaps the next lever to pull on, although I think there's some hype there. Revenue growth is going to come probably from just price increase coupled with, for all intents and purposes, a more comfortable consumer, that's US and globally. And then share count continues the idea that financial engineering is still important, right? Companies buying back stock, to reduce the number of outstanding shares. So earnings growth this year is forecast around 14% when coming into the year. I was a little bit concerned that number seemed a little ambitious. Right now, that number might actually be doable this year. We'll see again if the short-term market volatility creates some behavioral shifts, but if earnings did in fact trough last year and we start to see earnings return back to levels we saw in the last few years, right? And you don't have to necessarily get to those, massively high margins you saw in 2020, 2021, but if you get back to the margins we saw in 2018, 2019, that would, or 2017, 2018, that would bode well for stock prices. Here's the case for mid and small cap stocks, right? Like just from the standpoint of looking at this from, where there's value. And again, this is very clear, right? Like small cap stocks are controversial, right? Half of the Russell 2000, or even closer to 60%, doesn't generate earnings. Those are smaller technology companies. Those are biotechs that are kind of in R&D mode. And so we want to be very sensitive to saying we're not making a case to say like all small caps are the same. And also, you want to be very sensitive to the small caps that are kind of find themselves in the value universe. That's a lot of those, regional and small banks. But we're looking at small cap stocks today as a fairly small part of the favorable part of the market, right? Like small cap generally is a very small component of technology, right? But industrials, energy, some companies that are more cyclical, which are well priced or reasonably priced, could benefit from this cyclical upturn. And so again, it's not a bad thing to be, somewhat more, focused on adding to your small cap positions. Interest rates have definitely pushed. If you really look at kind of overlay small cap stocks for interest rates, there's a tremendous amount of correlation, and I think it's too broad of a brushstroke. You can't say all small caps are the same, and so if you're trading on rates, that seems to be somewhat of a weak argument for why you don't own some small caps or mid caps. Again, we're always going to have more large caps, like we're always going to have more U.S. versus international, but again, some at the margin makes sense. So let me go ahead and let you stare at this page for just a second. Again, there's a ton of data here. The point being is if you kind of stay to the left and you kind of shift to the middle and lower section, you're not nearly reaching the same way. But if you focus on the right, and up high, you're seeing that those valuations are a little bit more extended, right? So again, no reason to belabor the point. This is the one thing I do want to spend a moment on when we talk to clients through financial planning and really how you kind of model out the proper allocation. We just have to be somewhat thoughtful about future return expectations, right? When the market's averaged 13% a year for the last 10 years, which is the case for the S&P, it's probably unrealistic to expect the S&P to do 13% again for the next 10 years. Now, there's precedent, right? We saw the 80s, the market was up 14% per year for the decade, and then it stacked on top of that 17% per year in the 90s. But again, that doesn't happen often, and that oftentimes ends in tears, as we saw with the tech implosion and started kind of March of 2000. But again, from my perspective, 6+% returns, and this isn't price, right? You can add some total return dividend on top of that. For U.S. equities, 7% or so, and international, it's kind of developed world. People actually have a slightly higher view on emerging markets. But bonds, right? Like, for the last decade, you got a 1% return in fixed income, right? If you were lucky, cash was 0. And so you're getting a better lift from that part of the portfolio, which is, again, welcome to see. Let me, kind of take us home on the kind of equity markets and commodities, right? So Tom highlighted this a little before. Gold has been on a tear, right? Gold is at all-time highs. It's very interesting. Gold and Bitcoin are kind of moving in lockstep, not necessarily the same rate of change, but both moving up through the first quarter. And in the last 2-3 weeks or so, Bitcoin has kind of rolled over, whereas gold keeps marching up. Gold is benefiting from a couple things, right? Gold is benefiting from this kind of broader notion of debasement, right? Amounts of debt and deficits that we have continue to run or have amassed. And then, foreign buyers have started to say, hey, do I want to own the treasuries for 2 reasons, right? Do I want to own treasuries because, again, if they can't get their house in order, maybe they're not worth as much, or frankly, just a lot about, how well we've been able to kind of weaponize reserves, right? And so, the Russians found out the hard way that, when you had money parked in big U.S. banks and you did some stuff that was bad, we kind of prevented you from getting access to your money, right? So you're seeing some foreign buyers there. Um, Outside of that, right, like the commodity picture was somewhat mixed, right? Industrial metals, improved for sure in the back half of the first quarter, excuse me, and into the second quarter. Dr. Copper has, kind of indicated that China is maybe starting to, wake up, and again, you're seeing some improvement on food prices or food commodity outside of cocoa, right? Chocolate's going to be pretty expensive, but for us who need to lose some weight here before summer beach season, not a bad thing. And then, lastly, just really drilling down on oil, right? Tom had highlighted this before, when we released the strategic petroleum reserve in March of 2020, great timing, because oil was $123. Oil prices kind of collapsed, fell down in the, 70, high 60s, low 70s. We've started to see oil creep back up. That has a couple of impacts, right? One is it's clearly a headline for people as they think about inflation, but it also has some impact on just or is impacted by what's going on geopolitically, and whether or not Iran's supply, which has been making its way to China and others, is curtailed, which could lead to higher prices for U.S. produced or Saudi produced oil. But again, on a whole, right, production in the U.S. continues to be pretty impressive, right? I know there's a narrative that the current administration isn't all that pro energy. They haven't done much to stop the massive production from the shale producers. And again, I don't think that's going to change anytime soon, because now the profits are pretty good. So let me turn it over to Tom. I'm going to let my vocal cords rest for a minute, and Tom's going to take us into international and emerging markets.
Thank you, Jeff. Appreciate it. So we did look at this slide before, so I won't spend a ton of time on it. But I think if you look at the 3-month column there, which is the second column into the numbers piece, really, Jeff had mentioned this, it was broadening out of performance. You have a lot of countries, a lot of areas around the world who are performing really well over the quarter. Really, it was Latin America struggled. But if you look at the 1-year performance, it was up 23%. And then if you look at Hong Kong and China down below, the CSI 300 index was actually up 3.1%. But if you look kind of the 1, 3, and even 5-year numbers, not a very positive story to tell. But otherwise, diversification and really kind of as usual as I go through the international markets, the idea is really it's a case for diversification. So Jeff, if you flip to the next slide, I know we've shown this before, which is a slide that I really like, and is really a mirror of, there's a company called Callan, the Callan Periodic Table of Investment Returns. The idea behind diversifying, you don't want everything in large cap, you don't want everything in the United States, you don't want everything in treasuries, right? So if we use, we'll use REITs really quick. If you look at the top performing sector in 2021 was US REITs, 43.1%. Then you look at 2022, and those year numbers are at the top of the columns there. 2022, it was the bottom performing sector. It was down 24.4%, right? And then you look in 2023, it was kind of toward the middle, 13.8%. And you look at this chart, you don't see a really great pattern. Otherwise I would say, or other than when you look at that white with blue writing, diversified portfolio. So you look at that, some combination of it all, and you're getting an average type of rate of return over time. Doesn't work all the time, but if you look this 24 to 2023, or excuse me, 2014 to 2023, you get that nice kind of wave pattern in the middle of it versus riding the full roller coaster. Yes, we would all love the highs, but we get to avoid a good portion of the low, which is a very good thing in a bad year. Next slide, please, Jeff. So we've looked at this slide before. It's just cycles of the U.S. equity outperformance versus the EFA, so international markets. And you look, over the course of time, there have been periods where international markets have outperformed, U.S. markets have outperformed, but in general, very positive story across time. It just really is, as I mentioned, the case to diversify your assets, not just in U.S. stocks, but also international stocks. On the next slide, we're looking at 15-year averages for PE ratios. So if you look at the little box there, it's got the S&P 500 PE ratio 21.1% over the 15-year average of 16.4. Some of the international markets have actually caught up, where we've looked at it quarters in the past where the PE ratios were actually under their 15-year averages. They're a little bit over now. So if you look at the MSCI EFA there, 14.8 compared to 13.8. And then you look at the emerging market at 12.1 versus 11.4. So they've caught up a little bit. China's not helping. Some of the international markets, again, the performance has been really rough in China as it relates to the economy, but also specifically the market, and a lot of their stocks have really underperformed. If we jump to the next slide, again, I like this chart a lot in that it shows really just valuation above or below historic median. So you can look at countries all across the world, the US and Netherlands really leading the charge as far as just valuations being very, very high. And there are a lot of markets that are much more attractive than the US right now, just based on the growth that we've seen. And again, not to say that we won't see continued growth in the US. There are a lot of signs that point to, again, us moving back toward from late cycle to mid cycle, which would indicate that there's still room to run, but there's a lot of opportunity all across the globe. Next slide, please, Jeff. To dig a little bit deeper into China, I love looking at China. I love looking at India as two just massive countries, and China again being the #2 economy in the world as it relates to things like consumption. So this is really jumping into this quarter a little bit. Janet Yellen had come out and said, the U.S. is talking about putting tariffs on some goods because China's kind of looked at their domestic consumption numbers are very low. Their population doesn't consume a lot of the products that they produce. China wants to export as much as they possibly can to drive their economy forward. And when you think of what they could potentially do is, and something that I think they've been considering, is ramp up production and basically take all their goods and dump them onto the world markets. The challenge with that is any domestic producer, whether it be in the US or any other country that China exports to, it could kill their domestic producers, right? So if you think of electric vehicles, right, as an example, so EVs, what you wouldn't want to happen necessarily is China to produce a massive number of these, export them to the US, and then that kills, our ability to produce them domestically. And so that's where, the US is looking at it saying, hey, we might have to actually put tariffs on this if there isn't a little bit more balance between what China produces and what they're actually consuming themselves versus just exporting out to the world. If you look at the right side of this chart or slide, household deposits and loans. So, their deposits going down, the home loans haven't really picked up, so a lot of Chinese, like the average citizen, will put a lot of their savings into a second property, a third property, a fourth property, sometimes pooled with other people. And you just haven't seen a lot of that. And there isn't just a lot of confidence. If you look down at the chart down below, the blue line is residential property prices. So they've gone down over the past year plus, and that's shaken the confidence of the Chinese, average Chinese consumer and spender. Jeff, if you don't mind, jump to the next slide, please. So China has started to ease a little bit. They haven't really kind of gone all in on easing yet, but they're trying to spur on the economy. They're trying to get things going. They've been a little ahead of us in the business cycle, where they've been into recession already. And now you start to see, China's trying to get this going, but it is this excess capacity. It is, the struggle of the real estate sector that really have hurt the consumer confidence as well as just the economy. So this should be our final side here in the international space, which is India. In the section on the left here, there is a comparison: India, China, emerging markets, U.S., Eurozone, U.K., Japan, just as far as actual GDP and projections going forward. And so you look at kind of where India is, right, and where China has been, and the projection for China going forward, kind of coming back to, hey, they are a more developed country, and in addition to that, they have been struggling quite a bit, and a lot more. Upper right, working age population growth. You look at India, you look at Southeast Asia, and still even in the US, we're all positive. So many of the developed nations, essentially, like what happens when countries industrialize, people are going from the farm often to cities. And you see that in Europe, you see it in South Korea, and you've absolutely seen it in China. And China, along with the one-child policy, has just their demographic. Whereas what's interesting with the US is because we did industrialize, but we went to the suburbs before we went to the cities completely. So it actually slowed our progression. And so that's why we're not kind of in the same spot as Europe, or not in the same spot as China, or even South Korea, which is pretty interesting. Some of the government capital spending you can see below, just some coming from the states within India, some coming from the federal government, but generally the trend is very positive. And just with India's size, their demographics, their education level, things like that, it really does seem as though at this point that India is on the upswing. So that's really it for the international markets. On to fixed income. So if we look at really the first slide in fixed income, it does talk about a lot of the kind of 1 year, 3 year, 5 year, 10 year, and ultimately just over the last 3 months, as we said, treasuries kind of ticked up, and that hurt the performance of some of the bonds. But as you see, it wasn't a dramatic downturn, and even though I think over time, our hope and expectation will be that, for a 1 year performance, we're going to get more than, 1 or 2 or even hopefully 3%, out of our bonds. The yields are much better than they were in the past. So you have all these managers who are buying sometimes longer bonds, sometimes just higher yielding bonds than have been available in the last 20 years. Again, to have a little bit negative over the past 3 months, offset by the equities in your portfolio, it's okay for bonds to just kind of hold serve, stay where they are. But again, I would expect, bond numbers should, hold steady, if not turn positive, depending on kind of what happens with interest rates, and when the Fed decides to start to move in a less, or have a less aggressive stance as it relates to interest rates and the tightening measures they've taken. On this next slide, just higher yields usually come with higher risks. So, as we think about adding yield to a portfolio, we're also looking at the risk side of the equation. So, if you look at comparing toward the right-hand side or middle right of the chart, right, you have corporate bonds, you have preferreds. Corporate bonds, yielding historically 5.3%, as far as a yield to worst. Preferreds 6%. But then if you look at the light blue bars down at the bottom, corporate bonds negative 19.6, and then you look at preferreds negative 53.3%, right? So a lot more risk, sometimes for not that much additional yield. And so whenever we're evaluating any kind of addition or subtraction from the portfolio, we're looking at return, we're looking at yield, we're looking at the risk that is always a partner to that whenever we're constructing the portfolios, and again, making changes over the course of the time. On the next slide, federal funds path, so just projections, as far as rate cuts. This I feel like has been in the headlines, every time I feel like Jerome Powell says anything, the market is watching very, very closely, not been reacting, and lately negatively, because growth again has been above trend. We've had, the economy has been extremely resilient. Some of the spending that we've seen from the Biden administration, if it's Build Back Better, or it's some of even just like the student debt elimination, if we do actually get to that, and even the spending that we've seen on Ukraine, you know, the funding for the war effort, these are all inflationary things. And it kind of puts the Fed in a position to say, you know, yes, we would like to cut rates. Like, you know, we're trying to get to a certain number. Um, and I feel like every time we look at this chart, the numbers or the projections are a little bit different based on what's going on the ground, you know, what's actually happening. And what's going to end up being the impact of all these different things? You know, is it keeping inflation a little bit higher where the Fed feels like it can't cut rates? Or does it tick lower and they get to the point where they're comfortable to actually cut rates? You know, it's interesting. I've seen some statistics around the election, things like that. What does the Fed do? There are some instances where they've raised rates. You know, I don't think we're in danger of that at all at this point. Other times, you know, in election years, they've just kept things steady. Other times, they've actually cut rates. I think this will be an interesting election to watch with all of these factors weighing in. What does the Fed do? And I'm sure whatever happens, we'll have, you know, political reaction to that, saying, you know, the Fed is rooting for one candidate versus another. But again, something that we're going to keep a close eye on to you know, see how it's going to weigh on the economy, weigh on the market, weigh on portfolio. On the next slide, really, this is just expectations as it relates to where rates are going to go and really where they are now. I don't want to spend a ton of time on here, but you know, I think consumers have an expectation, the government has an expectation, traders and the market have an expectation. You know, everyone's kind of guessing where they think things are going to go, what they think is going to happen. You know, and we will see it play out one way or another over the course of time. On the next slide, talks a little bit about intermediate bonds versus short-term bonds. So when you come to the end of a rate hike cycle or hiking cycle, I should say, what happens next, right? So how do assets typically perform? And really what this just shows is intermediate bonds have outperformed short-term bonds historically when it comes to the end of a rate hiking cycle. So again, that can be somewhat instructive for us. What do we do as it relates to yields within the bond portfolios? What are the managers doing where we have active management in some cases with some of the bond portfolios? If they're lengthening their duration, we might not take any action to double down on that. If they aren't, and we think there's some additional yield, we may see some changes within the portfolios to start to lengthen duration a little bit, just to capture a little additional upside on the fixed income side of things. On the next slide, the Federal Reserve balance sheet. So it seems as though, again, the Fed is going to stop or has stopped increasing rates. If you look at the sub headline here, the pace of balance sheet runoff or quantitative tightening is also likely to slow or stop in 2024. The Fed's talked about it. They haven't put plans in place specifically yet, but it's just whether or not they keep their balance sheet flat, whether they're buying things which would inject money into the economy, or they're just letting things run off, which does ultimately tighten things. So the expectation is they're going to stop, you know, on the tightening side of things sometime in 2024, but they'll pay attention to what's going on and make changes as appropriate. The final slide of the fixed income section, just the spread between the 2 and the 10 remained inverted, meaning the 10-year treasury yield is lower than the 2-year. We do expect that ultimately the 10 will steepen as the Fed cuts rates. That'll impact short-term rates more than it will impact the longer-term rates. So short will come down, you know, making it more of kind of the traditional yield curve that we'd expect, where if you're going to loan your money to somebody, you should get a higher rate for a longer term versus the higher rate on the shorter end of the yield curve. So with that, Jeff, I'm going to turn it right back over to you.
Great, thanks, Tom. Appreciate it. Yeah, a couple of things to call out there relative to what Tom alluded to too. Like I think, you know, the idea that today we have real yields, right? So, you know, 10-year at 4.6 and inflation expectations somewhere between 2.5 and 3. You know, means that again, you're actually getting compensated for owning fixed income, right? You know, it not just on a coupon or nominal basis, but in real terms. So that's a plus. You know, let's just kind of, you know, focus on the long term or the view of like why inflation matters and why that does impact Fed policy. But inflation is something that we try to manage. Some people hate inflation entirely. Our economic model is based on, some positive amount of inflation because it encourages economic activity, right? If you thought prices were to stay flat, you'd have no urgency, or if thought prices were going to go down even worse, you'll wait. And so we do want to have inflation at something around 2-3% in the long run, broadly too, but in some instances, 3% is okay too. When inflation does run in that kind of healthier territory, right, market can support a multiple of around 20 times, kind of where we are today. So I didn't want to, kind of after throwing water on the fire earlier, which wasn't my intent, just to make sure people realize, hey, look, if we're getting inflation back to levels that are palatable, and again, I don't think this is, we made the progress, that was it, and we're going to start to bounce back to where we were in 2021, 2022. It's just maybe a bit of an air pocket, or a period where we just have to fight a little bit harder to get past inflation. But we've seen plenty of pockets of inflation, right? World war times oftentimes are inflationary. Clearly there's a few instances there, you see that. But again, directionally, I do think we're just going to revert back to the stuff we've seen the last 20, 30 years, which is demographics, debt, and technology, all being things that are kind of more disinflationary, if not in some instances deflationary. A slide that Tom and I know very, very well, right? Going back, to our prior lives at Fidelity. It's a really helpful slide for people to kind of understand. Like if you go back and look at the last almost 45 years, every year you see a drawdown, right? Like sometimes a drawdown might be just a couple percent, or others it's 50%, like you saw in '08, right? The average is you'll see a decline of about 14%, right? Which is again kind of mind-boggling, but that's not unreasonable. We're down small cap 7%, big companies 5 or 6%, right? So again kind of par for the course. Last year we saw a correction that took place from like July through October, largely in the back of worries that the Feds still need to hike rates. The last rate hike was in July, but they hiked and they didn't say we're going to stop hiking. They said, hey, we're going to pause. And again, so the market kind of read that as maybe they do hike again. And by October, it was clear that they weren't going to, and we saw the rally thereafter. But again, we like corrections. We like them not because we want to have our clients be uncomfortable. We like them because they restore the equity risk premium. Without volatility, returns come down, and you may as well have everything in a CD, right? This is really a busy slide, and the idea is some of us actually have people who have investment time horizon that looks like this. So if you started with $1 in 1926 in U.S. large cap companies, that dollar's worth $11,000 today, right? So 11,000-fold increase. Again, that's 97 years. I'm not sure anyone who's attending the call today will be here 97 years from now, but for your grandkids or your children, right? Like that's a very good reason why you throw money in the market. And things like World War II or Black Monday or the Great Financial Crisis end up being interesting talking points when you look back at them. Let me go ahead and I'll hit a couple other quick slides. I'll turn it over to Tom to take us home on a couple slides, and then I'll wrap us up today. I know, again, it's been a longer discussion. We'd like to spend time with you, especially when the market's a little bit more jittery. This is really, again, probably the best way of thinking about your investing, right? So if you're investing for a year coin toss, right? Markets go up or down, generally speaking, not much different than flipping that quarter. But if your time horizon starts to look more like a rolling 5, 10, or 20 years, the probability for loss dissipates markedly, right? And so we impress upon people is by the time you get to a 5 or a 10-year period of time, your returns on a worst case basis are low single digits. Best case basis might be mid 20s. And then over a 20-year span of time, we've never seen a diversified portfolio lose money, right? Like again, ever and never are words we don't like to use in our business, but if you go back and a lot of data says, hey, 20-year rolling period, the probability is basically 0. So most of you are investing for 20 years, or your money will be here for 20 years or more. So keep that in mind. Tom, I'll kick this one to you, or maybe this was for me, but you can speak to this one if you don't mind. Give me 1 second, sorry. Sorry, you're muted, Tom. My apologies.
Sorry about that. This is one of my favorite slides. I love showing clients this and talking through it. Whenever we're going through one of the little red boxes down at the bottom, you know, a bear market, a pullback, right? You could look at it and you go, there's 2000 to 2002, there's 2008, you know, there's 2020 and 2022 as the most recent four. Those periods of time feel awful when we're going through them. But if you do compare the duration and you know how much the market actually goes down during that time compared to the blue, where you get these long stretches of time, very often of outperformance, of great returns. It's easy to kind of get lulled to sleep during those great periods of time. But the nice thing is even when we have a pullback in the market, even when we have a downturn, you know, historically speaking, right? And everyone will always give you the disclaimer that past performance is not a good indicator of what's going to happen in the future. But when you think of this, the magnitude and the duration of bull markets that we've gone through, this is the reason people invest, right? Is because the market historically has gone up a lot more than it's gone down. So as I said, just one of my favorites to cover. I love looking at it because it's a great reminder, you know, when the market stinks for a period of time that you know, you can look at it and say, it's okay, I'm going to buy some things on sale right now and things are going to come back. The politics piece, we're probably going to keep hitting on this, you know, through November. You know, if you look at it, long-term investment has been rewarded. It doesn't matter as much who is the president at the time or the election cycle that we're going through. Long-term investors get rewarded, and you know, and there's going to be a lot of noise. You know, there already is a lot of noise, but it's probably going to get louder and more intense leading up to the election. But again, we have to kind of keep our eye on that long term and stay invested, stay disciplined, and we should be in good shape. If you look at the next slide, the next slide really is just, you see different paths and similar end is the title of this slide. So, you know, the orange is during an election year. You see the volatility, right? The yellow is not during an election year. You see the volatility. And ultimately, toward the end, they end in about the same place. You know, essentially is what the chart is looking to convey, just from a historical standpoint. And that's 1928 through 2023. Again, there are going to be ups and downs. There are going to be things that are going to happen during the year. There's going to be noise. Just stay invested, stay focused, stay disciplined, and we're going to end up in a good spot, hopefully. As you look at is cash king, this is another one that I absolutely love. On the left-hand side, how often cash underperforms. So over a 1 year period, 79% of the time. As you go further and further out, you know, 10 years, it gets to 90% of the time. You would have been better off in being invested versus being in cash. And over 15 and 20 years, it's 100% of the time. And this is not an argument to have you invest your emergency funds. We all need emergency funds. We all need some cash, no question about it. It's just this sometimes I think is informative as it relates to how much cash you actually should have and you want to have over the course of time. And then it talks on the right-hand side, if you look at it, how much do you underperform the market by, right? Anywhere from 9%, as you see over a 20-year period, all the way up to 334%. So compound growth is a very powerful thing. You know, and there's a famous Einstein quote that essentially says, it's the eighth wonder of the world. And, you know, some people earn it and some people pay it, you know, and you want to be on the earning side. You want to be someone who's invested for growth over time. You get rewarded for it. That's it for me, Jeff. So back over to you.
Thanks, Tom. Appreciate it. Look, I'm sure everyone who stayed on the whole call, because we're here at the hour and 20-minute mark, you know, might have a headache or be a little dizzy, you know, but we do really thank you for the time, right? So, you know, I want to just kind of hit on a couple of things as we think about Q2, right? I do firmly believe that the next rate is low, the next move is lower, right? The Fed will cut at some point, probably in 2024. They don't want to keep rates at between 5.25 and 5.5. They know that that's above, their long run neutral. They just want to have a little bit more visibility into what's going on with inflation domestically, but also abroad, right? We do expect banks abroad to start cutting as early as next month. That's probably the UK, and June is probably when the ECB launches their easing cycle. And what's interesting is you see their economy starting to recover a bit, and you couple that with monetary policy. That's a reason to be somewhat optimistic as you think about investing overseas. Um, recession risk in the U.S. has now actually slid back to kind of the longer average. Like for the better part of 2 or 3 years, we were looking at an elevated recessionary risk. Now we'd say the odds are in that 20% or under territory, which is encouraging. I know we're all sick of hearing the soft landing. Like God forbid we're in Newark Airport and we're still waiting for the pilot to put the plane down. We would have thrown up a couple times. I'm kind of sick of the soft landing statement as well. But it's important to realize that what the Fed is trying to do is to orchestrate a pretty tough thing where managing labor markets to make sure we don't see a big uptick in unemployment, while again making sure people don't get totally anchored to higher inflation. Unemployment probably will trump the inflation concerns now that inflation's back into the threes. If inflation was 7 or 8 or 9, right, as it was in 2022, it was very clear, and that's why Jay Powell had his famous August Jackson Hole speech. That inflation was much more of their priority. Yeah, we talked about this a few different times in the slides. Again, rotation isn't about timing or selling. It's just there's opportunities to be made, or opportunities abroad or outside the kind of mag 7, and so we just want to make sure that people are aware of that, and we're positioned accordingly. Duration, as Tom alluded to a little bit, we thought bonds were bid up a little bit too much at the end of last year when rates essentially were at 3.8%, and fair value was probably in that 4.25 or 4.5 territory. We've overshot that now. We're back to around 460, maybe 470, and so that makes sense to kind of extend duration a little bit, kind of locking in a 10-year treasury type investment with a 4.7% return. Hey, you make 50% on your money over the course of a decade. Not terrible, right? And then, the political posturing, right? Just in the last couple of days, Trump is talking about a flat tax of 17% for everybody, right? Biden is talking about reintroducing the 39.6% tax bracket, going back to the Clinton days, right? And so, you've got, a lot of buzz. And so the prior slide that Tom had shared about, the election cycle, right? Q2 is always, I would say always, but very much the kind of bumpy quarter in an election year. But as we get closer to that time, I think people will probably just be happy to be done with it. But again, we invest in the markets, we invest in great companies, and we invest in this economic engine that is US GDP and global GDP. And I'm as optimistic as I can be as I think about, 3, 5, 10, 15 years. So folks, we just want to, again, thank you for the time. We'll cut it short here in terms of Q&A. We'd ask you to reach out to us relative to your personal portfolio or if you have questions. But again, thank you so much for spending your afternoon with us. And again, looking forward to having Maddie back next week.